All right, what's up everyone? This is Scott here again with my next live trading video. Today is Friday, May 27th. And in this one here, we're first going to take a look at the broader markets, and I'll be assessing whether or not right now is a great opportunity if you're a bear like myself to re-enter the market with some bearish trades and to play for a downside reversal. And actually, I've already gone ahead and made a trade to reflect my bearish assumptions here, and I'll review that trade with you in detail in this video. And then also, I'll make a second new trade today in Roku that's going to be a bearish-skewed short strangle. Now, as always though, before we get started, in case you are brand new to the channel, again, my name is Scott, and I just want to let you know that you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out, and when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Okay, so first off here, let's take a look at the broader markets, and we'll begin by taking a look at SPY, which is an ETF that tracks the S&P 500. We'll go ahead and zoom in a bit here on this chart. And so as you can see here, for the past few weeks, SPY has been stuck just trading sideways in this nice price range here, with a high of around $410 per share and a low of around $385 per share. So basically this support level right here is the major line in the sand, so to speak, that's keeping the market propped up currently. Right, so far every time SPY goes down to this level, it has found support and bounced off that price. And then so far as well on the upside, SPY has had a very hard time getting above around $410 per share. As you can see, there's a lot of overhead supply here, basically acting as resistance. So that's why I've gone ahead and I drew in this line right here as a major barrier for the S&Ps for the time being. And ultimately, this right here, this is the reason why I personally think that right now would be a good time or a good opportunity to step in and play some bearish trades. Of course, I'm definitely not trying to predict the future here by any means. That's certainly impossible in financial markets. All I'm saying here is I do think there's a good chance, perhaps a greater than a 50-50 chance, that the market could reverse off this price level right here. And that's what trading is all about, right? You're basically trying to find situations that have a good chance or good probability of you making money on the trade, but it's never going to be a 100% guarantee of making a profit. Now, also, what about the NASDAQ? So briefly, we'll come over here and go to QQQ, and then we'll also zoom in a bit on this chart as well. And so as you can see here, we have a very similar story as with the S&Ps, where the NASDAQ is also stuck in a price range here, but the NASDAQ definitely has more potential room to run to the upside. Right, currently I have the next major resistance point right here in white at around $312 per share, but currently QQQ is only at about $306 per share. So therefore, if this current broad market rally that we've been seeing over the past few days does continue, it might be mostly tech stocks that are continuing to lead the charge. And then finally here, let's also take a look at IWM. This is an ETF that tracks the Russell 2000 index, which is mostly small cap companies. And once again, let's go ahead and zoom in on this chart. And so just like the S&P 500, the Russell 2000 now is just touching its major resistance point at around $185 per share. So again, we have a lot of overhead supply over the past few months here acting as resistance. And I do think, again, this could be a great point to play for a downside reversal. And so ultimately, that's why I already went ahead this morning and placed my first bearish trade to reflect my assumptions here. And I did so in UAL, which is United Airlines. And so UAL and other airline stocks are very heavily correlated to the Russell 2000 index. And so because of that fact, plus the fact, if I zoom in on this chart here, also with UAL, I do think we have reached a major resistance point on the chart here at around $47.50 per share. So you can see many times in the past where this stock tried to get above that point, but ultimately it failed. And the one time it did manage to get above and stay above that price for a little bit of time, it ultimately ended up failing and falling back below it. So once again, I do think the odds here do favor a short-term reversal, but of course I could be wrong, which is why I did not lay out a bunch of new bearish trades today, just this first one here. And so in particular for this trade, I sold 2 naked call options with a 50 strike. So definitely wanted to give myself a little bit of cushion in case I am wrong on this trade and UAL does continue to push even higher. And just to be a bit more specific, if we come back to the monitor tab and I'll show you the actual orders I made this morning. And here we go. As you can see, again, I sold 2 contracts of UAL 50 strike call options in the June 17th monthly expiration cycle, which as of right now have 3 weeks until expiration. And each contract I sold for a starting credit of $124. So in total times 2, that means my total starting credit is $248. And then also the way I'm going to manage this trade or defend it basically in case I am wrong on this position here is if UAL does cross or go above 50 bucks per share above my call strike, at that point I'm going to purchase 200 shares of stock, right? 100 shares per contract, and therefore convert the naked call options into covered call options. And then conversely, if after that point UAL does reverse and fall back below 50, then I'll sell the shares for a small loss and carry on. But real quick here, just to show you how I'm going to do that in a very automated fashion, let's now come back to the trade tab here and we'll go to UAL's already pulled up. Awesome. So now I'm going to go ahead and click on the current price of UAL and then go to buy custom. I already have an order template set up for this position here. So we'll go down to U through Z and UAL. And so as you can see here, I basically have a chain reaction of orders that are going to repeatedly buy and sell the stock if it crosses 50 and then falls below that multiple times. And basically the way you can do this in thinkorswim is by taking advantage of the first trigger sequential advanced order type, which basically means that each one of these individual orders will get triggered one by one sequentially, one after another. So basically my first order here is a buy order to purchase 200 shares of stock. And these are all stop limit orders where my stop price on this first one here, I'll set that to $50.50. So basically if UAL crosses this price, at that point this first buy order will become active and try to purchase 200 shares of the stock. And then for the limit price, which is basically the highest price that I'm willing to pay for these shares, I'll set that to maybe 51. And there we go. So again, if this order does get triggered and I do end up buying 200 shares of stock, then this order will now become the next one in line to possibly become executed. And this one here is going to be my sell order to now sell the shares if UAL falls down to below, let's say 50 bucks per share. So 50 exactly will be my stop price on the sell order. And then for the limit price, I'll set that to perhaps $49.50. So now in this case, if both of these orders do get executed, I will essentially buy 200 shares of stock at a price of around $50.50 and then sell them for a loss at a price of around exactly 50. So that means I would lose 50 cents per share here, which times 200 shares would be $100. And taking a loss like that would still be much less than my starting credit of around 248, I believe. So at that point, if this does happen, it would not matter. I can still carry on and make no adjustments on this position. Of course, also my maximum profit will also get reduced a little bit by taking this loss, but that's simply the risk I'm willing to take in order to defend my trades in this way. Right, because defending naked call options in this way by purchasing stock and converting them into covered call options, that allows me to still make money potentially if the stock price does increase by an infinite amount above my strike price. Essentially, as long as I still have an overall net credit still remaining on this trade after I purchase those shares, then I can simply hold those shares until expiration, assuming UAL does stay above my strike, and then by expiration, I'll still walk away with a little bit of profit. So bottom line, either buying or shorting the stock to defend your naked option trades gives you the opportunity to make money if the stock moves quite literally in any direction and in any kind of market environment. So back to my orders here, I can simply repeat the process for all the remaining orders in my chain here. So basically for this next buy order, I'll set my stop price to, once again, $50.50 and the limit price to $51. And so now let me go ahead and fill out the rest of these orders here. And here we go, all the prices are set on all 8 of these orders here. So now last step is to just confirm and send all these orders. And then one more thing I want to mention here is if those orders get triggered a lot, right? If I go through multiple cycles of having to repeatedly buy and sell the stock for losses each time, eventually, of course, I am going to lose my starting credit. And at that point, I'll have to start making adjustments to this position. And the way I would do that for a naked call option position is by selling naked put options to collect additional credit. But we'll cross that bridge only if we need to. All right, so that was my UAL position. And now, like I mentioned, we're also going to put on a new trade in Roku, which is going to be a bearish skewed short strangle. So now we'll come up to the charts and we'll go to Roku. And for those of you who watch this live trading series pretty closely, I know I did already have a Roku position on recently, but that one came off yesterday for a profit. So basically, I'm going to reload once again on this stock. The reason being, of course, is that the implied volatility for Roku is still very high right now. Although, of course, also, as you can see here, it has come down quite significantly over the past couple weeks, which is why my recent strangle in the stock has already come off for a profit. So bottom line, with the implied volatility still being very high, so are the prices for Roku options. And right now the IV is still around 85%, which translates to an IV rank of 52%. That's pretty good. And also an IV percentile of 73%. Also very good. So once more, these two indicators are confirming the fact that option prices for Roku are still pretty inflated for the time being. And therefore, they're definitely worth taking a look at to possibly sell. Now in terms of the price action chart, let's go ahead and zoom in a bit here. And so for Roku here, we've been seeing a very long general trend of repeated lower highs, one after another. Right? Every time Roku has a short-term little rally right here, it usually tops out at a price lower than the previous rally or the previous high. And so currently the lowest low Roku has made so far is around $75 per share. And looking at the most recent high, that topped out at around $100 per share. So point being, for this bearish skewed strangle that I'm going to put on here, which again is basically a combination of selling both an out of the money call option as well as an out of the money put option, I'm going to make sure to pick my call strike to be above about $100 per share, and the put strike is going to be below $75 per share. Right? Basically, I want to accommodate some more room to the downside, in particular for Roku to possibly turn down lower. Right? Again, keep in mind, I do think the broader market has reached a major resistance point and is possibly due for a short-term correction. So again, that's why I want to make sure I leave some room to the downside for Roku to fall and not blow through my put strike quite yet. So now I'll come over to the trade tab here and take a look at the option chain for Roku. For this trade, I'm still going to be in the June cycle as well with 21 days left to go. Reason being is these monthly contracts oftentimes have the best liquidity or the most actively traded contracts. And so for the call side here, I think I'm going to go with the 106 strike call option. So $6 above 100, which is kind of that major resistance point or the most previous high Roku has made. So give myself a bit of cushion there. And then on the put side, again, the recent low Roku has made was around 75. So I'm going to go with the 70 strike put. Now, the reason why the strangle here has a bearish bias to it is because of the deltas of the contracts. So the delta on this put option is only 9, but the delta on the call option is 28. So basically this means if Roku does start to move back down lower, then that directional move of the stock should make for some profits on this overall position. And then of course you always have time decay working in your favor as an option seller as well. And then finally, of course, if the implied volatility for Roku does contract even further, that's also going to help my position too. So with that said, we'll come back to the trade tab and make this trade official. We'll go to this call option here and right click and go to sell and strangle. And here we go. This is the order to sell one contract of the 106 strike call alongside one contract of the 70 strike put option. And total credit is going to be about 350-ish bucks. I'll come down to maybe 355, and then we'll go to confirm and send. And the buying power effect on this trade is less than 1,000 bucks. That's fine. Still well under 5% of this total account value. So the risk on this trade looks good, and now we can go to send. And there we go, just got filled and price improved to 356. Awesome. And next step is to create my closing order on this trade. So now we'll right click on the call option again, but this time go to buy and strangle. And here we go. This is my closing order to buy back both contracts. And as usual, I'll try and do so for half price. So half of 356 is 178. And then we'll make this a GTC order so it's always in place, and confirm and send that one as well. And this trade here, I will also manage using my personalized stock hedging approach, where I'm either going to buy stock if Roku crosses my call strike, or short stock if it crosses my put strike. Now, because currently Roku is pretty much right in between my strikes, I don't know whether I should set up right now at least a shorting or a buy order. So therefore, for the time being, I'm just going to set alerts to notify me if Roku gets close to one of my strikes. And then at that point, I can go in here and create either my stock buying or my stock shorting orders. So real quick, we'll come back up to the price of Roku, click on that, and go to create alert. And again, my call strike is at 106. So we'll say if Roku stock gets to above, let's say 100, let me know. And then at that point, I'll create my buying orders, just like what you saw with UAL. So then come down here and click create. And then one more time, come back up, click on the current price of Roku, create alert. And my put strike is at 70, so we'll say if Roku falls down to a price of maybe 75, then let me know. So once more, come down below and click create. And so there you go. Those are the two new trades I made for today, both of which reflect my bearish assumptions on this market. And of course, if I am just totally wrong on these trades here and the market continues to go higher and higher, then I will defend these positions in the ways I've described to you in this video. And so with that being said, that's going to do it for this one here. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.